Welcome to TradeTheMBI.com. My name is John. This is a discussion of my view of a hedged position, what it constitutes, how it looks, and what some of the goals and ideas behind it are. In our example, we had been referring to Intel, and at this point, this was back in June of 2012. We went ahead and decided to go ahead and look at Intel. A couple other ones we were looking at were X, JPM, NVIDIA, and we'll look at a couple of those in their current states in just a moment. But the idea behind it was that we wanted to secure entering these stocks that offer dividend plays and not really have a downside risk, considering the market had just achieved new highs and it was looking kind of shaky at that particular point. Well, in this case, the recommendation, unlike your typical married put, which is where you buy at the strike that you're purchasing at, and maybe a month or two, and you're just looking to hopefully have the price increase above you. Here, what we're doing is we're buying a 26 put. Now, in this case, that's quite a range over. Typically, we'll usually look for around 10%. Typically, is the sweet spot, so to speak. But in this case, that would have been about the 24, but we were looking at an advantageous setup with the way premiums were working under the current market conditions. But it gave us a total cost of $26.85, and with the put at 26, we were guaranteed to exit at 26. So we had 85 cents. We're less concerned with that overall setup than we are with our ability to make weekly income off of the setups while limiting our risk. And in this particular case, we had some strong views as to the direction of the market based on our indicators, and we were able to go ahead and sell puts as well as calls. Now, in these cases, often these puts were just naked puts, but they can be done as a spread, where in this case you would have sold the 22 and perhaps bought the 20 for a few pennies. And nonetheless, the idea was to reduce this upside down feature of 85 cents, or about 3% of the trade. Should we have done nothing, that's exactly what we would have ended up with, is be a loss of 3.2%. But with the number of weekly options that we could trade, that was never going to be an option. And you can see that it barely took within less than a month. The price really hadn't moved a whole lot from that particular area. And you can see all the way through October, price was even below what the original purchase was. But by the time we reached October 6th, of that same period, we'd already made $3.13 on Intel, over 11% gain, and that option was still worth quite a bit of money because it still had most of its intrinsic value and it still had time value. Even as this taping, which is all the way into 2012, right before the actual expiration, that option is still worth $1.17, and prices all the way up to $25 for Intel. So you can see that this would have allowed you to hold on to this stock for a 6-month period with virtually no risk, still making plenty of money, allowing you to capture the dividend, and never being really concerned about some of the talk that was going on that the market could free fall. And within these trades, we do quite a few different setups overall. Currently, all the way January 4th of 2012 here, we have JPM at $35. Well, looking at it to April for the 38 strike, so that's about $3 in the money. It's going for about $4.50. Well, it gives us quite a few options when we begin to set up a trade like this, because given our models, we know that there's potential that, well, maybe we feel that JPM is going to decline a little bit because we've had some movement in the extreme histogram or one of the other indicators, and in which case all we have to do is reduce this $4.50 exposure either by buying the stock lower, by selling a variety of puts, calls within that time period. Any combination of those can equal a profitable scenario. For instance, if we were to just go buy the stock right now at $35, we'd have about a $39.50 exposure for a stock that's at 35. So that's quite a bit we would have to overcome. But we have all the way through April, and we're going to be selling puts and options. Now, in the next day or so, the weekly option comes out for this one, and if this trade is implemented, then more likely than not, we'll be selling a 35 put, maybe even the 34 strike, depending on if we fall in between there, and capturing some of that difference in between it. And then each week building towards moving that from a negative to a positive and compounding it. You can see here for USX, similar kind of concept. Um, at the current level, 28.60 was the going price for it. 440 was that option all the way through April of 2012 at the 30 level. So that's only $2, a little bit less than that at the current price, a dollar something. So you can see how rich that premium is, and we take advantage of that oftentimes when we did trade X by utilizing ratio spreads, where in this particular case, since we own the stock and a put, what we'll end up doing is we'll sell 2 calls at a higher strike and then buy 4 at the strike above, because we're likely to see greater moves in a stock like X and that, and so we can take advantage of some of those key signals that we end up getting based on our indicators. Here's one that you would just go ahead and start right off the bat. NVIDIA, currently selling $14. The June, so that's 6 months out, $16 put, a little over 10% from where the current price is. $2.90, it gives you a total of $16.90 for your cost. With a $16 exit, you're upside down 90 cents, or about 5% on the stocks. That's typically the maximum setup you could be in that you would probably lose, anywhere between 5 and 8% for exits, a little bit more simply because of the volatility of it. But we've mixed stocks that have more volatility and a little bit less volatility to give us a little bit more of a range to play with. But in this particular case, that 14 put is going to be coming out in another day or so, and we may be able to get 25-30 cents for it. L, if we're able to get 25 or 30 cents entering at 14, we'll be able to take that off that 90 cents that we're upside down. And so what happens is, over time, you begin to gradually build your position within these setups. And the way the trades will work is each week, probably on the Thursday, I discuss what we're looking at for the next week, and then I'll make a recommendation for that Friday morning, or for a trade to be done at the close of Friday. And that way everyone will have plenty of time to make these, and you shouldn't have to do anything to the trade unless something special happens until the following week, in which case the next series of options come out. And then each week we do that. And some people say to me, well, but what if I miss a week? What if I'm not around? It's not really an issue. You have the protection where you're covered all the way through June. People who know they're going to go on vacation, do something like be gone for a couple of weeks, they can trade the monthly option as opposed to the weekly option. So it gives a lot of flexibility, doesn't require a lot of attention. Certainly you can be more active. You can even day trade within these setups, because at any point, if I decide to sell the stock, and expecting a market to decline a little bit and then buy it back, I've effectively shorted the stock by capturing that difference. And there will be plenty of opportunities where we'll make day trades within these as well. So hopefully that gives you a broad scope of what we plan to do with our hedged positions. And if you look at some of the links that we provide on the website, then you'll be able to see some of the other trades that we executed through 2011, give you a better idea of how profitable it can actually be.